Welcome back, everyone. This week, we're going to talk about CAVA, a Mediterranean restaurant that recently has IPO'd and seemingly is getting a lot of headline press and media attention, and not just because of the roadshow, but I don't know, maybe it's something new and exciting going on. I'm not quite sure why a restaurant is getting so much attention, but when there's not much going on, anything will do, I suppose. So it goes public. It upped the IPO price to $22 a share. It was thinking about, I can't remember, 17 or 18, and then it bumped it up to 19 or 20. But the point is, it began trading at $42 a share, almost twice the IPO price, and it initially issued 14,444,444 shares, which gave it roughly $2.5 billion valuation, and then it bumped up to almost $5 billion at one point. And then it's kind of interesting side note is that following the offer, there will be an additional 111.4 million outstanding shares, and it also granted underwriters a 30-day option to purchase around 2.2 million additional shares at the IPO price. So here it is trading, and by the way, there's no lockup, which is to say, and if you don't believe me, here it is. This is part of the IPO filings, the SEC filings. It's just hard. It's just hard to wrap your mind around these things sometimes. To see, like, the nonsense never stops. And I'm not amused by this really at all. I guess it's entertaining, but I'd rather be entertained by less sad things. And it's sad because God knows somebody out there is getting all bullish on this, just like somebody got all bullish of Airbnb or Peloton or Affirm or so many other IPOs. And they're like, it's great Mediterranean food at a good price, and they're growing and revenues are going up, and they're going to get sucked in this narrative and then lose their ass. And that's not so good. Now you can say if they just did their due diligence, but people don't really do too much of that. Like, everything I've uncovered here was, I don't know, let's just call it 2 hours worth of work of due diligence. And I'm not even really interested. I'm not interested in buying this company. And it's just a sight to see. So it's just these IPOs, there's data. At some point I might do an entire video on this, but there are studies out there that show that on average, if you buy an IPO at release, I want to say in a 3 to 5 year time frame, you will lose money on average. And that's because it's the same playbook. And the problem is that people never seem to learn lessons. And they misdiagnose, and by miss I mean not completely diagnose, old times. So you have the dot-com bubble. It was like telecommunication and everyone got excited. But what the majority of people seem to miss is that much of what made that happen was all these companies issuing a small portion of the entire float, and then these funds cornering the market, essentially bidding it up. More money flows in through their funds because now they're outperforming and believing in the future and whatever narrative that people like to hear. And they ran the prices up. And what happened was that it became too much for the market. And when all the IPO unlocks happen, roughly 180 days after, the insiders start dumping their shares because they're in it on pennies on the dollar. They don't care what price it is. Just imagine CAVA, IPOs at 22, trades up to 44 on the first day. Who knows what the next 6 months is going to be like, 180 days. And these insiders have shares for free. Yeah, they're locked up. They can't do anything. But if you're in a bull market like the dot-com bubble was, or the big SPAC bubble we had not too long ago, you would learn that these markets run up and then they don't care. They just smash the sell button. And in this case, they issue 14.4 million shares roughly. Well, there's 111 million shares outstanding. They issued roughly 12% of the float. Now we're going to get to this in a moment because this isn't a trivial matter. So I did the suffering so you don't have to, and watched mainstream media on CAVA. This is a gentleman interviewing the founder of, oh man, I want to get this right because I actually like their bars. It's not the Cliff Bars, it's, I want to get this right. Kind Bars. So here the CEO of Kind Bars, or owner, or I don't know, founder of Kind Bars, is being interviewed, and because apparently he's an expert on the matter, because, you know, food is food, I suppose, and a good appeal to authority, and he invested in the F round in, I think, 2021, and then beforehand in 2019, and he's a long-term investor and doesn't care about the unlock. And I'm actually quite interested in 6 to 12 months to see if he actually sells any once his shares unlock, because he said explicitly that this is, I think he even said decades, and that he doesn't care about the unlock. So we'll see about that. And then this gentleman is the one we're going to be, on the right, is the one we're going to be speaking of in a moment. And then here Kramer's tracking the action in Chipotle's IPO to make sense of what to expect from CAVA. Like, what? Of all the companies, and notice in the background, Chipotle. Like, selection bias and framing effect are real phenomenon that speak to you in a subliminal way. And you better be cognizant of it and have the metacognition and self-awareness to understand that it's going on in your environment and impacting you. Because there is a lot of references to Chipotle, which is quite interesting. Like, why Chipotle now? That's because Chipotle's the big winner of restaurants. But, you know, Texas Roadhouse has actually done pretty darn well too. And there's other ones that haven't done so well. So why aren't we comparing it to them? Benefit of the doubt? Assuming good faith? Or are we naive? It's worth asking. We're also going to talk about this one. I wanted to show this video, but I transcripted it because I didn't want to get some copyright infringement or violation, so I just transcripted it. So let's transcript this one. So the gentleman in the middle, like I already forgot his name, David or something. There's Jim on the right. But the middle guy says, "You're still talking about years before you're profitable." And then the CEO says, "No, if you simply look at the restaurant level profitability, look at our cost structure, you can have line of sight soon." And the interviewer says, "What's line of sight?" And the CEO says, "You can see line of sight. You can read the S1. You can read our numbers." That was the guy's response. Like, maybe there's some reason that he can't disclose when they're going to be profitable. I'm not quite sure. But here he is saying, you can see when we will be profitable, but I won't tell you when we are profitable. That's kind of the same silliness that the government says, we know how much you owe us, but we're not going to tell you how much you owe us. Or because he actually knows this is oh, what's the right word? You gotta be careful with the words you use. Well, that he's grifting and knows that there's a good chance that they won't be profitable in any near term, which is in part what the market's betting on, is that they'll quickly turn around to actually being a profitable company, and not just a profitable company on some specific metric such as restaurant level, because that's tricky. Like, well, if you're profitable on the restaurant level, then how are you not profitable altogether? But that's because of how they like to move the numbers around and play accounting shenanigans. Just like all-in sustainable cost isn't actually all-in sustainable cost when it comes to mining companies, because they don't count the write-downs and goodwill impairments and so on and so forth. You know, things that they spent real money for, and then that doesn't, for some reason, get factored in, or greenfield projects that go nowhere. Like, somehow those things don't matter to sustaining a company, which is a blatant lie, but people put up with it, so they keep doing it. So what I essentially learned from watching these videos is there's a bunch of softball questions that seemingly CAVA is profitable on a per unit basis, which is to say something along the lines of revenue minus cost of goods sold, as well as selling and marketing, which, if you know, aren't all the expenses of a business. So that's why they reference that number. It's not by accident. Yet again, selection bias. There's some good cop, bad cop going on when there's two interviewers, which is an interesting psychological dynamic that I can't help but think, one's being nice and optimistic while the other one's being tough but fair. It's like, but it's a contrasting phenomenon, because you have one guy who acts really nice, and then another guy who, by contrast, seems harsh and fair and to the point, but in reality is himself soft. And if you actually looked at the vast spectrum and continuum of investigative journalism, you'd realize that they're both, a joke. That there's a lot of comparing to Chipotle, but not Texas Roadhouse or Red Robin or Cheesecake Factory or Wendy's or so many other companies, that they sold roughly 14.5 million shares. The guy I said that we would be talking about in a moment, let's go back. This guy on the right, he knows the game. I can tell you that he knows the game about the dot-com phenomenon, about a tight share float to be able to ramp up the prices. Look, market volatility is inversely proportional to market float, which is to say market volatility is prices going up and or down. So what's the best way to make a price go up? Well, one of the best ways to make a price go up is to restrict the share count, because it's easier to move it up. So that guy said, when asked, because the interviewer said they only issued 14.5 million shares, and he was like, me as an interviewer, if I went public and issued shares for myself, I could get more than 14.5 million shares. And the guy being interviewed said, you got to start somewhere. See, that's called a non-answer. That's a platitude. And I would say it's intellectually dishonest and disingenuous, because he's purposefully concealing information that might actually reveal why they issued so few shares. And I would say that ultimately this is just another instance of investors subsidizing consumers, just like Peloton or Airbnb or Uber or Lyft or these food delivery services or the Bird, that scooter company, and on and on and on it goes. So if you consume these things, have at it. Go to a CAVA. The profitless, they're losing money on the bottom line. Well, how can they stay in business if they're losing money on the bottom line? It's that they're getting cash injections. Where are they getting cash injections from? Investors. Okay? It's amazing how everybody wants to talk crap on rich and wealthy people and investors and so on and so forth, but it's hard out there. There are a lot of predators and vultures trying to take your money to burn it. And why not? If I have an unprofitable company and I can get you to invest in my company, and that gives me on promises of me expanding and growing and so on and so forth. And I know maybe I do believe in it and I'm just a fool, or maybe I do believe in it, but externalities occur like COVID that prevent it from actually manifesting and occurring, or whatever else. But just imagine a real grifter and knows that he can now extend his business for another year, another 3 years. Well, why would he want to do that if it's unprofitable and he ultimately knows that it's going to collapse? The reason is because that's another year or 3 years that he gets paid as a CEO of the company. You're supplementing his lifestyle. Now, I'm not saying this is the case here or with all companies, but many of instances it is, and it's something you should always consider and think about. Sweet Green. Jim Cramer actually brought this up. Interestingly enough, for as much crap as people talk about Jim Cramer, I would almost say that out of the interviews I saw of him and his Quick Money show or whatever it is, Fast Money, I don't know, that he was actually telling people that he actually thought the stock would double rather quickly, and it actually did, and that he would advise strong caution. And then in another in an interview he was doing, he actually was speaking to the CEO there and said, some people are comparing you to Sweet Green, some people are comparing you to Chipotle, and of course those are just placeholder terms and metaphors and examples for unarticulated underlying phenomenon and ideas contrasting on a whole spectrum, which is to say that you'll be a poor performer or a optimal performer. And he's the only one I really saw mention that. So don't be cavalier with your with disclaimers. They're there for a reason, and you should take them seriously. Yet again, the problem is everybody's become desensitized to disclaimers and say, yeah, we know, whatever. Just like if you go look at these YouTube videos of people getting hurt or fails or however they word it, they always say, this person didn't get hurt, this person didn't get hurt. And I think they just say that just to say that, because some of those videos, those people had to have gotten hurt. And it also begs the question, what do you mean by hurt? So there are risk factors, and in their S1, in their prospectus, they link in the description. Feel free to look at it. I think page 37 is risk factors, and there's a bunch of them. You actually have to think about these things and take it seriously. No company really is in isolation, in a vacuum. They're in a complex, interdependent world in which a lot of variables affect them, and you should get familiar with those variables. You could say they're the only or the biggest Mediterranean food provider. Well, that presupposes that that's a large enough market for them to scale into. And that maybe it's more of a coastal phenomenon. And I think they're in like 22 or 26 states. Maybe there's a reason why they're not in these other states, because the demand is lower. I mean, I don't know. I'm just making this stuff up. I'm literally just making it up as I'm talking right now. But seemingly, these questions I'm asking are more serious questions than practically any of these reporters inquired about. So Wasteland Capital on Twitter, you should follow him. Has a lot of information. And, well, we pretty much criticized the whole thing. And they delivered a net loss of $59 million in fiscal year of 2022 compared to $37.4 million in fiscal year of 2021. By the way, you can find this in the S1 and the prospectus. It's in there. Like, at least pretend to Google it, open it up, scroll through it haphazardly and say, okay, I've done my due diligence. I mean, at least try to make an effort to do nothing. And a lot of people don't. I don't know how many people I've talked to that don't know the bare minimum. They don't know what a 10K or a 10Q is, but here they are with this money talking about how it's going to rocket ship emoji to the moon. It's like, at least be able to baffle me with BS or dazzle me with your brilliance. And you should at least know the rudimentary things, even if you don't even utilize them. So he goes on to talk about how this sounds like poetry and how they use a bunch of flamboyant terminology and words that really don't mean anything. And I guess they mean something. They speak to a narrative and hit your emotions. And that's really what the manipulation is all about. And he says, the funny thing is, CAVA bought publicly listed Zoe's Kitchen for $300 million in 2018 at one-time sales. Zoe's had $300 million annual revenue then. Now, just 5 years later, they're flipping it to market at approximately 4.4 times sales, $2.5 billion on $564 million of revenue last year. Just incredible. It is. This is an amazing arbitrage. They essentially bought something for one-time sales, and then a few short years later, they're now marking that up to sell it at 4.4 times sales. And that's what they did. They're not trying to. This is what they did. This is simply incredible arbitrage. CAVA is converting Zoe's locations and revenue that they acquired at one-time sales into CAVA locations and including that as CAVA brand revenue growth. There's no limit to the daftness of the IPO markets and bankers who take advantage. And as a side note, for those who balk at Twitter, you should ask yourself, why isn't this being brought up during the mainstream media roadshow coverages? While the CEO goes around talking to everybody. Why is no one talking about this? Why is no one bringing this up? Why is no one discussing it? I mean, really, it's a compliment. Hey man, you guys bought something at one-time sales and now you're flipping it around and selling it to the market at 4.5 times sales? Like, good job. Like, you must have offered a lot of value add. See, you could spin it in a positive light. You are tactical, strategic business makers who take advantage of good deals, and then you put your own name on it, value add, spin it around, and make it a much more profitable business. And people should want to invest with you because of your ability to do things like this. And if this is any indicator of your potential in the future, then you should bet on this jockey and bet on this horse. Like you could spin that. But seemingly that's just too complicated, or because there's underlying suspicions underneath it, so it's best not to draw any attention to it to begin with. I'll let you decide. So, this is an interesting phenomenon. At a market cap close to $5 billion, which is what CAVA is at now, it's worth more than Wendy's, Shake Shack, and Papa John's. Independently, not cumulatively. Now that's kind of interesting. CAVA, which I didn't hear about until a few days ago, is worth more than Wendy's. Like, I've not gone to a CAVA. There's one within, 45 minutes of me. I might go there. I actually really do enjoy Mediterranean food. And I think I would like it better than Wendy's, but I mean, I don't know that more than Wendy's? Like what? And there, as this noted, I think the last few slides noted 9 times sales multiple. They're saying 10 times sales multiple, which isn't quite right because that means it'd have to have a market cap of 5.64 billion, but you get the gist. And then we have this gentleman who is a CNBC host, I believe, and gotta say, CAVA was legit. $14.98 for a spicy chicken pita and seltzer, and unlike other joints, the spice hurt in a good way. Food should hurt a little, like love or being a Chargers fan. Now, you should actually find this to be a little alarming. This is the kind of joke that media is. Now I understand he's talking for himself. This is his account. He's not being a representative of anybody, but he sure is wanting to cross that line into gray area, right? See, because a good product doesn't mean a good investment. And to conflate the two categories is intellectually dishonest and disingenuous. And a good investment needs a good product, but a good product doesn't mean a good investment. And you shouldn't get that twisted. Good, the food's cheap. We already talked about that in the subsidizing. What does that have to do with investing? And then to make a joke and lightheartedness of this, and it's like it's not funny. Like who do you think's watching you? Is it retail crowds? Is it people like every day? Yeah, they should do their own due diligence. Then why even are you on the media? Because you're obviously really not even putting out any relevant information out there, and barely skimming the surface, and are lighthearted and joking when you do talk. So if you're not there to actually point people in the right direction and provide insight and a fair, balanced story, then why even exist? Which is why less and less people watch these medias. Here's a good one. Since, and this is crossing that boundary, that line, that gray shady area. Personal account, but spokesperson for CNBC in journalism, as we'll note here. Since CAVA stock doubled today, I did the only thing a respectable journo would do, which is an endearing slang term for journalist. I went there and stuffed my face. These people are not your friends. I would actually say they're the converse of friends. They're the opposite. They're not your friends. The only thing a respectable journalist would do after a stock is doubled, not discuss its value and its worth and projections and what's wrong with things, and how stories are getting spun and narratives are getting spun and propaganda is getting put out there, not cautioning people about the absurd evaluation and how it's trading at a higher multiple than practically most other restaurant companies that are actually profitable, and that this is just a pump growth story and questionable prospects to profitability, and how the CEO wouldn't even tell you when he thought they would become profitable. No, a respectable journo ate the food. Like, that's disheartening. It really is. And I understand I'm being a little too serious about this, but I would also say I'm not being serious enough. And someone has to be serious about this. Sure as hell aren't the journalists, is it? At least not these people. This was a fun comment in relation to the last post, which is CAVA, $22 a share. Bankers sold it for $42 a share. Market bought it at $45 a share. Looks to me like CAVA left $300 million on the table. Anytime Wall Street says an IPO was successful, that is code for the company got screwed and the bankers got a pile of free money. Now, I think in part this is a snide, cynical, sarcastic viewpoint that isn't all inclusive, because you can go SPAC, you can go IPO, direct listing, over the counter. There's many ways to come to the market, and there's different reasons you do it the way you do. They wanted $22 a share. They got $22 a share. CAVA didn't leave anything on the table. Now, why did they pay the bankers? Is there a reason they paid the bankers? What do the bankers do? Well, these bankers are on the sell side. Guess what they get to do? You get enough bankers involved, they can create a lot of hype. Right? They're harvesting the premium from their hype. And it doesn't always work this way. You know, sometimes something opens and it falls. Sometimes something opens and it just kind of trades sideways. Sometimes it IPOs and maybe slowly and steadily goes up. Okay, so a sample size of one isn't a good attitude. Yet again, this is the opposite. The other comments were a bunch of jokers outside of Wasteland Capital and the one after that, but this is the snide, cynical, conspiracy theory attitude that doesn't help you either. It also misrepresents reality. But what they did say was true. And it is worth thinking about, because you really do want to ask yourself, why is this trading where it's trading? Why is it IPOing now? And the problem with this cynical attitude, and oh my God, it's trading at 10 times revenue and no one else trades for 10 times revenue, and all these hyperbolic statements, both to how their food's so delicious, so it must be a good investment. Of course, they have the plausible deniability because you inferred that and they didn't imply that, which is a bunch of BS, but it gives them wiggle room from not having any commitment or culpability or skin in the game. And then you get this side where you have a snide, cynical, sarcastic approach, and then you're like, well, everybody got the cream off the crop. And then I said earlier about how most IPOs on a longer time horizon lose money after 1, 3, 5 years. So you might get it in your head. And there were quite a few comments like this through the different tweets and YouTube comments and so on and so forth about other articles where people published pieces, and then the comment sections and those. So across a vast array of different media outlets, I saw this sort of comment, which is short it to the ground. Well, what did I just say not that long ago about, and this is the last slide on all this, what did I say earlier about how they issue a tight float to ramp up the shares, to keep the shares, quote unquote, artificially high, to buy time for the IPO unlock for everybody to dump their shares? So maybe the time to short it would be around the IPO unlock, not right now. Or maybe it would be. But this is a decision-making process, and you're playing an iterative, repeatable game over the coming decades of investing. This is not a winning strategy. Just because something IPOs and is hyped, can you imagine all the IPOs, the SPACs and 21 bubble, or let's go back to the dot-com bubble, or other bubbles. The rubber boom of the early 1900s. There's a lot of bubbles. And can you imagine shorting telecom companies as they IPO'd one after the other in 98 and 99 as they doubled and then tripled and quadrupled? I mean, it's absurd. And short it to the ground. Short how? Right? Are we buying put options in which you only lose the premium or the price you paid for the options? Or are they actually talking about shorting in which your losses are theoretically infinite, in which you'll be margin called and have to put up more money on your short as it gets squeezed higher because of the artificially restricted small float? The problem is that there's not always a way to play an idea, or you have to finesse it and be creative. Like I said, IPO unlock. Shorting it now is, I'm not going to in any way. And then it might be hard to borrow shares if you actually are shorting, and then if you're trying to express it through options, the premium that you might have to pay for that, plus it's newly issued, so what kind of contracts are even on the options market, if any? You have to factor and consider all this in. Sometimes the best thing you can do is just sit it out. Not being stupid sometimes is the best thing to do. Not betting against stupidity, because sometimes it'll just run you over because you try to force a trade. And if this trade doesn't have a way to be profitable, even though it's overvalued, you should not short things just based upon valuations. That's a dangerous game to play. Ask anybody who went into the year short NVIDIA for the sole reason that it was trading at, 50 or 40 times sales or something, with a bearish tilt towards the market and the economy as a whole as a macro overlay. They got absolutely destroyed. All the things you need to know have been learned by other people. And the internet is a marvelous place to explore this and learn from them, so you don't make your own stupid decisions and repeat their stupid decisions. So with that said, on to my portfolio review. So here we are. I can't say much has really changed from last week. The market's up more. SPY's up, 3 some odd percent, and I don't know what the NASDAQ's done. My names aren't really going anywhere. As typically what happens, they pop on Monday, and then bleed off and taper off and in lower on by Friday, and then next week's this was a triple witching, quad witching week, options expiries, this and that, and next week's a 4-day trading week, and then after that it's a short week before the month's end. I've actually been kind of bullish the market, even though I'm building cash, and I mean I've been bullish and bearish. I've been torn, and I'm kind of turning more bearish, just at least short term wise, of the broader market, which is unfortunate because if that does pan out, and say you just get a 10% pullback, no crash or anything crazy, 5%, whatever, and I mean these names, uranium you could say has done well over the last couple of weeks, but so far this year, not looking too impressive. And same thing with offshore oil. And the thing is, or some other names I've been looking at, regional banking's had a bounce, but it's not done much lately in the past week or two. And the thing is if the market pulls back, so the market's been up and to the right, and then these names have been trading sideways. So what does that mean if the market falls? So I'm not going to participate to the upside, but I will participate disproportionately to the downside. That's a potential risk, which is one reason why I'm building up cash, is to capitalize on that if it does occur. But that's all to say that I'm not really too optimistic about the upcoming weeks in regards to my portfolio's performance. So far for the month, I'm actually outperforming the SPY, but I mean, we have another week and a half, so what? That's really all I have. I've kind of exhausted myself talking and being critical of IPOs and the disingenuous nature of reporters and the lethargy in which they conduct themselves and the disingenuous way they report themselves as being some kind of a, I don't know, fighting for the small guy or something. I don't even know. It's just cringe. So I guess this was a more sad video. Sorry about that. But I'll leave it off there, and until next time.